For the last decade or so, if you were investing in stocks, there was pretty much one game in town, the United States. I mean, the US market has just been the undisputed champion. But that incredible dominance is now starting to raise some really serious questions. Okay, get this. Right now, US stocks make up a staggering 75% of the MSCI World Index. And if you're not familiar, that's a huge benchmark for global stocks. I mean, to put that into perspective for you, back in the 90s, that number was just 30%. Think about that jump. One single country's market is now absolutely dominating the entire world. So the big question is, how on earth did this happen? And maybe even more importantly, what does this crazy level of concentration mean for your portfolio? We've really got to dig in and understand what's driving this American dominance and, what risks might be hiding just below the surface. All right, let's get right into it because this performance gap we're seeing, it's not just some recent thing. Nope. This is a story that actually goes back over 100 years. When you look at the long-term data, it's pretty clear. I mean, since 1900, U.S. stocks have given investors a 6.5% annual return, and that's after inflation. Now, compare that to the rest of the world combined. They've only returned 4.3%. That is a huge difference over time. And you know what? That gap has only gotten wider lately, especially since the 2008 financial crisis. That outperformance has just hit the accelerator. It's really cemented the US as the place to be for investors. So this long, consistent run of success really makes you wonder, what's the secret sauce here? So what is the secret sauce? Well, it turns out there isn't just one magic bullet. It's actually several really powerful interconnected forces that have all been fueling this American exceptionalism in the markets. Okay, first up, how companies spend their money. See, US companies have been on an absolute buyback spree. They're just repurchasing their own shares left and right. And what that does is it reduces the total number of shares out there, which automatically boosts earnings per share, a huge win for investors. Now, on the flip side, you look at many emerging markets, and they've been doing the opposite, diluting shares. That's when they issue new stock, and it means that existing shareholders end up with a smaller slice of the pie. Reason number two, the whole world basically runs on the US dollar. It's the planet's main reserve currency, and that gives the United States what's famously called an exorbitant privilege. It's a huge, huge advantage. Yeah, and this legendary quote from way back in 1971, it just nails it. This power lets the US borrow money super cheaply and have this incredible economic influence all over the world. And that creates a stable environment that, you guessed it, global investors absolutely love. And driver number three is the pure strength and resilience of the U.S. banking system. Think back to the 2008 crisis. American banks were forced to rebuild their capital, and man, did they rebound strongly. Their European counterparts, though, not so much. They've lagged way behind, and that's created yet another deep structural advantage for the U.S. economy. But here's the thing. This incredible winning streak, it's not all sunshine and roses. In fact, you could argue that this very dominance has created some new and pretty significant risks for all of us as investors today. For starters, the US market has become, dangerously concentrated. I'm talking a massive 45% of the S&P 500's entire value is now locked up in the tech sector. And that sector, as you probably know, is dominated by just a handful of companies. Yep, the Magnificent Seven. Just let that sink in for a second. Over half of the entire market's outperformance is coming from just one sector. What that means is that a totally unprecedented slice of the market's fate is now resting on the shoulders of just a few tech giants. That's a lot of eggs in one basket. And this kind of concentration is making some analysts draw a really chilling parallel to a specific moment in history. For anyone who remembers it, 1999 was the absolute peak of the dot-com bubble, right before that historic and very painful crash. So here's why that comparison is so scary. This number you're seeing, that was the total cumulative return of the S&P 500 for the entire decade that came after that 1999 peak, a whole lost decade for U.S. stock investors. It's just a stark reminder of what can happen when concentration and valuations get way, way out of whack. So that concentration risk, it leads us right to the next huge question, price. Have investors, in all this excitement, just bid up U.S. stocks to levels that are, just too expensive to keep going? And when you look at the data, you see this massive valuation gap. Right now, investors are paying almost 30 times trailing earnings for stocks in the S&P 500. Now, that PE ratio, that's just the stock price divided by its profits from the last year. And paying 30 times earnings is just huge, especially when you compare it to the 20 times earnings investors are paying for global stocks outside the US. So get this, not only are US stocks expensive compared to the rest of the world, they're also super expensive compared to their own history. And historically, when you pay this kind of high premium for assets, it usually leads to some pretty disappointing returns over the next 5 to 10 years. It's just a pattern we've seen before. Okay, so given these sky-high valuations and all this heavy concentration in tech, what's the smart move for investors looking ahead? Where do we go from here? Well, if you listen to some of the biggest investment firms in the world, they're all pointing to one word: diversification. JP Morgan, for instance, is suggesting that a strategic allocation of around 25% to non-US stocks could really improve a portfolio's resilience, protect it a bit if there's a US downturn. And here's the key. Diversifying isn't just about playing defense. It's about playing offense, too. It's about getting access to those cheaper valuations we just talked about. It's about reducing your portfolio's dependence on US tech. And maybe most importantly, it's about capturing opportunities in other global markets that could be ready for their own big run of outperformance. Which really brings us to the ultimate question every investor has to be thinking about right now. History shows us time and time again that market leadership is almost never permanent. It moves in cycles. So, after more than a decade of this historic US dominance, the real question is, are you ready for a world where the cycle finally turns? Hey, if you enjoyed this breakdown, please don't forget to subscribe to Finance Deep Dive. It honestly makes a huge difference and really motivates us to keep making more of these for you.